The average American savings account is paying 0.38% right now. There are accounts paying more than 10 times that today, with the exact same federal insurance behind them, and your bank has zero incentive to tell you about a single one of them. Here is what that gap actually costs you. $50,000 sitting in a typical big bank savings account at 0.38% earns you about $190 over a year. That same $50,000 in a top-paying account at just over 4% earns you north of $2,000. Same money, same risk, same government backing. The only thing that changed is which account it was sitting in, and that single decision is worth roughly $1,800 a year for doing nothing but moving it. So I pulled the 5 categories actually paying the most as of July 2026, ranked from the easiest to set up to the one paying the highest headline rate. Number 1 is where almost everyone should start. Number 5 is the one barely anyone bothers to set up, and it is quietly paying more than everything else on this list. Quick note before we start. I am not a financial advisor. None of this is personalized advice, and every rate I mention moves. Check the current number before you move a dollar. Number 1. The online high-yield savings account. This is the boring one, and it is boring because it works. As of July 2026, the top online savings accounts are paying somewhere in the range of 4% to 4.2%. Newtek Bank's personal high-yield savings was paying 4.20% and got so much demand it stopped accepting new applications and started a wait list. PBank is around 4.10%. Synchrony, Marcus, Ally, and the rest of the online names cluster underneath that. Here is why this category exists at all. An online bank has no branches, no tellers, no lease on a corner lot in every suburb in America. That entire cost structure gets handed back to you as a yield. A traditional bank has to fund thousands of physical locations, and they fund them with your 0.38%. The important detail nobody mentions. These are almost always FDIC insured up to $250,000 per depositor, per bank, per ownership category. That is the same insurance protecting the money in your 0.38% account. You are not taking on extra risk to get 10 times the yield. You are taking on the inconvenience of one afternoon of paperwork. What to actually look for: no monthly fee, no minimum balance, and no cap on the balance that earns the advertised rate. That last one is where the games get played. A bank will advertise 4% and then quietly pay it only on the first $2,000. Number 2. The money market fund sitting inside your brokerage account. This is the one that catches people off guard, because most people already have the account and never turned it on. If you have a brokerage account at Vanguard, Fidelity, or Schwab, the uninvested cash in that account is sitting somewhere. Sometimes it sweeps automatically into a money market fund, earning a real yield. Sometimes it sweeps into a bank deposit program paying you almost nothing, while the brokerage keeps the spread. The Vanguard Federal Money Market Fund is showing a 7-day SEC yield around 3.58%. That is a bit below the best savings accounts, so on the headline number, it loses. But 2 things are happening underneath that headline. First, money market funds move fast. When short-term rates rise, these funds reprice within weeks. Bank savings rates lag, sometimes by months, and banks are much quicker to cut than to raise. Second, and this is the part that matters, a government or treasury money market fund holds mostly treasury securities, and the portion of the income coming from those is generally exempt from state and local income tax. If you live in a high-tax state, that exemption can close most of the gap with a higher headline savings rate. If you live in a state with no income tax, it does nothing for you. Same fund, different answer depending on your zip code. Go log into your brokerage and find out what your cash sweep is set to. It takes 90 seconds, and a meaningful number of people find out they have been earning almost nothing on a 5-figure cash balance. Number 3. Treasury bills bought directly. The one-year Treasury was yielding around 4.12% as of late July 2026. Shorter bills, the 4-week and the 13-week, sit closer to 3.7%. Treasury bills are the closest thing to a floor under this entire conversation. They are backed by the full faith and credit of the United States government, which is a stronger backstop than FDIC insurance and comes with no $250,000 limit. If you are parking a large amount of cash, this is the category where size stops being a problem. The tax treatment is the real argument here. Interest on Treasury bills is fully taxable at the federal level, but it is exempt from state and local income tax across the board. In a state charging you 6 or 9%, a 4.12% Treasury can beat a 4.3% CD on the money you actually keep. The headline number and the number that lands in your pocket are two different things, and nobody selling you a CD is going to run that math for you. The catch is liquidity. You are committing for the term. You can sell a bill early on the secondary market, but you take whatever price the market gives you that day. This is money you know you do not need for a defined window. Number 4. The CD ladder. Top 12-month CD rates have climbed to about 4.30%, up from roughly 4.10% 4 months earlier. That is the highest straight yield on this list so far, and you get it by agreeing to leave the money alone. The mistake is putting everything into one long CD and then needing the cash in month 4. The fix is a ladder. Split the amount into equal pieces and buy CDs maturing at staggered intervals. 3 months, 6 months, 9 months, 12 months. Every 3 months, one matures. You either take the cash or roll it into a new 12-month CD at whatever the rate is then. What the ladder actually buys you is protection from being wrong about interest rates. If rates fall, most of your money is already locked in at today's higher yield. If rates rise, you have a piece coming due every quarter to reinvest at the better number. You stop needing to predict anything, which is good, because almost nobody predicts this correctly with any consistency. Check the early withdrawal penalty before you sign. Some are 3 months of interest. Some are a full year. That number is the actual cost of being wrong about your timeline. Number 5. And this is the one paying the most. The requirement-gated hybrid checking and savings account. Axos One is currently advertising up to 4.21% on savings, which is the highest number on this entire list. Higher than the best plain savings account. Higher than the best 12-month CD. It is also the account almost nobody opens, and the reason is sitting right there in the words "up to." That top rate is conditional. You have to actually route direct deposits through the account, hit a monthly deposit threshold, keep a minimum balance, or some combination of the 3. Miss the requirement in a given month, and the rate drops, sometimes to something barely better than the national average. Banks build these accounts for a specific reason. A savings balance can leave in an afternoon. A checking account with your paycheck landing in it every 2 weeks is sticky, and sticky deposits are worth far more to a bank than idle ones. So they will pay the highest rate on the board to capture your direct deposit, and they are betting a meaningful share of customers will forget to keep the requirement satisfied and quietly fall to the low rate. Which is exactly why this is the best deal on the list if you are the kind of person who sets it up once and does not break it. You are being paid a premium for being organized. Your paycheck is going somewhere anyway. Point it at the account paying 4.21% instead of the one paying 0.38. Confirm you clear the requirement and set one calendar reminder every quarter to verify the rate you are actually receiving still matches the rate you signed up for. That last step is the whole game across all 5 of these. The number that matters is not the one in the advertisement. It is the one on your statement. If this saved you an afternoon of research, subscribe to the channel. I break down exactly this kind of thing every week. No hype,